Usually when we talk about fixing a machine, right, there's this expectation of physical precision.
Yeah, absolutely. A very tangible cause and effect.
Right, exactly. Like if your car breaks down, the mechanic opens the hood, points a grease-stained finger at I don't know, a busted alternator, and just says, "There's your problem." You can see it. You can physically touch it.
And you can replace it. That kind of mechanical clarity is, well, it's deeply comforting, honestly. We humans really love a physical, tangible problem. A broken gear means the wheel stops turning. It's entirely visible.
But imagine trying to fix a machine where the gears are completely invisible, where the engine spans an entire subcontinent, where the fuel is literally just human trust, and the levers you have to pull are hidden behind this massive, complex curtain.
That is a completely different ballgame.
Right. So, welcome to this deep dive. I want you, the listener, to imagine you are sitting at the central command desk of the Reserve Bank of India. You are tasked with managing the financial plumbing of one of the largest economies on Earth. And your mission today, well, our mission today is to master exactly how that invisible machine operates.
We are really going to look under the hood of market operations. And look, if you're preparing for an exam on this topic, it is so easy to get lost in this absolute sea of acronyms and dry
Oh,
definitions.
for sure. The textbook definitions can be brutal.
They really can. But knowledge doesn't stick when it's just memorized by rote. It only sticks when you understand the physical, real-world mechanics of how those acronyms actually move money around in the system.
Yeah, our goal is that by the end of this deep dive, you will possess such a structural, intuitive understanding of these operations that you honestly won't even need to look at your study materials for this chapter again. We are going to dissect the entirety of Chapter 4 of the RBI's Functions and Working Booklet, from domestic monetary policy to global foreign exchange. And we're doing it not by reading definitions, but by putting you in the driver's seat.
And to do that, we have to start by completely resetting how we think about the central bank's relationship with the broader economy. Like, we need to look at the ultimate goal first.
The big picture.
Right. The primary objective of all these market operations is something called the transmission of monetary policy to the financial system.
Okay, transmission is a word that gets thrown around a lot in economics, but let's actually visualize it. I mean, we can think of the Monetary Policy Committee, the MPC, as the brain of this massive economic body, right?
I like that analogy.
Yeah, so the MPC sits in a room and makes a decision. They say, inflation is getting a little too hot, we need to cool things down. So they determine the policy interest rate and they set the policy stance.
But the problem there is that a brain cannot physically move a muscle on its own.
Exactly.
It can only generate a signal. If the MPC declares a higher interest rate, that's just, a statement on a piece of paper. The local bank branch in your neighborhood doesn't magically change the mortgage rate they offer a home buyer just because the MPC issued a press release. That signal has to travel.
The nervous system literally has to carry that impulse from the brain all the way down to the fingertips. If the transmission mechanism is broken, the brain is shouting, but the body is completely paralyzed.
Which is a terrifying scenario for an economy.
Truly. So the central bank's market operations are essentially that nervous system. They are the daily, hourly actions taken to physically force that policy signal into the actual financial system.
Which brings us to the ultimate metric of success. How does the central bank know if the signal is actually reaching the muscles? Well, they look at their specific operating target.
And for domestic monetary policy, that target is the WACR.
Yes, WACR.
Okay, let's unpack this acronym immediately, because if you're prepping for this exam, you need to know this inside and out. WACR, weighted average call rate. Let's not just memorize the words, let's break down the actual mechanism. Expert, let's start with call rate. What makes a rate a call rate?
So it refers to the call money market. This is the absolute shortest term borrowing possible in the financial system. We are talking about overnight on-call money.
Overnight, literally just for one night.
Exactly. Imagine it's the end of the business day. Bank A has disbursed a ton of loans and suddenly realizes they are slightly short of the mandatory cash reserves they are required to hold overnight.
Right, they have a legal requirement.
Yeah. And Bank B, on the other hand, had a totally quiet day and has excess cash just sitting around doing nothing. So Bank A calls Bank B and says, hey, I need to borrow 50 crores just until tomorrow morning. The interest rate they agree on for that specific overnight loan is the call rate.
Okay, that makes sense. But what about the weighted average part? Why not just an average?
Because throughout the day, Hundreds of these overnight transactions are happening between various banks all over the place. Some are for 5 crores, some are for, 500 crores.
Right, huge discrepancies in size.
Exactly. You can't just take a simple average of the interest rates because the tiny transaction shouldn't have the same influence as a massive one. So it is volume weighted. The massive transactions pull the average much harder than the small ones.
I see.
The WACR is the true volume-weighted pulse of what overnight money actually costs in the system.
Now, I want to push back on a really specific characteristic of this call money market. The text defines it as an uncollateralized segment of the money market. The participants are strictly banks and primary dealers. But uncollateralized, that sounds inherently dangerous.
It does sound a bit wild at first glance.
Yeah, I mean, if a regular person goes to a bank for a major loan, the bank demands collateral, a house, a car, business assets. Why are these massive financial institutions lending each other hundreds of crores overnight with literally zero collateral?
It sounds reckless until you really look at the participants. I mean, this isn't the open public market. This specific segment is completely restricted to banks and primary dealers.
Because it's an exclusive club.
Very exclusive. These are highly regulated, systemically crucial, heavily scrutinized entities. They are operating within a closed loop of extreme institutional trust.
Because they know the central bank is basically watching everyone's books anyway.
Exactly. The central bank sees everything. And honestly, the lack of collateral is a feature, not a bug.
How so?
Well, demanding and transferring collateral takes time. It involves paperwork, legal valuation, friction. When you are just trying to balance your books at 4:30 p.m. for a loan that will be paid back at 9:00 a.m. the very next day, you need the transaction to be absolutely frictionless.
Ah, okay. So uncollateralized lending allows money to move at the speed of a phone call.
Precisely. Frictionless movement. So, tying this all back to the main goal, the central bank's daily endeavor is to ensure this WACR is aligned to the policy rate on a daily basis.
And think about why that alignment is so critical. If the brain, the MPC, sets the policy rate at, say, 6%, but the actual WACR floating in the market is swinging wildly up to 8% or crashing down to 4%, you have a massive problem.
You've completely lost control.
Right. It means the central bank has lost control of the nervous system. The actual cost of money in the real world is just ignoring the brain's commands. So aligning the WACR to the policy rate is the daily proof that the central bank actually has its hands on the steering wheel.
But here's the thing. A central bank cannot simply send an email to all the banks demanding they trade overnight at exactly 6%.
Right. They can't just mandate the outcome.
No, they have to physically force the WACR to align. And how do they do that? They pull levers to manipulate the money supply. They manage liquidity.
And before we get into the levers themselves, we have to be incredibly precise about what liquidity means in this specific context, especially for the exam.
Yes, very important distinction.
Because in everyday conversation, liquidity might mean how easily you can sell your house or how much cash you have in your checking account. But that is not what we are talking about here.
Not at all. The technical definition of central bank liquidity is strictly reserves provided by a central bank to the banking system.
Just to the banking system.
Yes. We're only looking at the closed ecosystem between the central bank and the commercial banks. Remember, the central bank operates as the bank for the banks. When they want to lower the WACR, meaning they want to make overnight money cheaper, they inject liquidity. They push extra reserves into the banking system. More supply of money means the price of that money drops.
Basic supply and demand.
Exactly. And if they want to raise the WACR, they absorb liquidity. They pull reserves out of the system, which creates scarcity, and that drives the overnight interest rate up.
Now, here is where the actual mechanical engineering of this invisible landscape gets really, really interesting. The central bank doesn't just have one single lever for liquidity. They have a massive toolkit. And understanding how these tools are categorized is crucial for you as a learner.
You really have to mentally divide these tools into two distinct buckets.
Okay, what are they?
Transient liquidity tools and durable liquidity tools.
Transient and durable.
Right. The distinction between transient and durable is basically the difference between treating a symptom and curing a chronic condition. Transient means short-term, temporary, fleeting. Durable means enduring, persistent, structural.
Okay, let's visualize this. Managing transient liquidity is like managing the physical cash in your everyday wallet, right?
That's a great way to look at it.
Yeah, so on a Tuesday, you might be temporarily short a few bucks because you bought a more expensive coffee than usual, so you borrow 10 bucks from a friend. Then on Wednesday, you find a $20 bill in your jacket, so you have a temporary surplus. It fluctuates day by day, hour by hour.
Exactly.
But durable liquidity, that is like negotiating a permanent change to your overall salary or restructuring a 30-year mortgage. It is a fundamental shift in your baseline financial reality.
So let's start by unpacking that transient bucket, the wallet management tools.
Yeah.
The primary framework here is the LAF, the Liquidity Adjustment Facility.
The LAF. And under the LAF umbrella, we find operations like overnight and term repos and reverse repos, and these can be at fixed or variable rates. But instead of just listing the word repo, let's actually walk through what a repo looks like in practice, because I feel like if you can visualize a repo, you understand the entire transient bucket.
Absolutely. So a repo is a repurchase agreement. Let's go back to our friend Bank A. It's late in the day, and they are short on reserves. They need cash to balance their books, but maybe the WACR is running too high.
Yeah.
And they just don't want to borrow from Bank B.
Right. It's too expensive on the open market.
Right. So they go to the central bank's LAF window. Bank A says, hey, I need cash. The central bank says, okay, I will give you cash, but I need collateral.
Ah, so here they do need collateral.
Yes, dealing with the central bank requires it. So Bank A hands over a government security, a bond, to the central bank. And the central bank hands Bank A the cash.
But wait, it's not a permanent sale, right? They didn't just sell the bond.
No, it's a repo.
Yeah.
Embedded in that transaction is an ironclad agreement that Bank A will repurchase that exact same bond back from the central bank tomorrow, or maybe in a few days, at a slightly higher price. And that price difference, that is the interest rate.
Okay, so the central bank injected liquidity. They physically gave Bank A cash, but it is entirely transient. Because tomorrow, when the repurchase happens, Bank A has to hand the cash back, and the central bank hands the bond back.
Exactly. The liquidity was injected for maybe 24 hours just to smooth out a temporary bump, and then it vanishes.
And a reverse repo is just the exact mirror image of that, right?
Correct. A reverse repo is when the central bank absorbs cash by giving the bank a bond, with a promise to reverse it later. These are the surgical tools used to iron out the daily, minor wrinkles in the WACR.
Okay, and the text mentions the transient bucket also includes the SDF, the standing deposit facility, and the MSF, the marginal standing facility. We don't need to get bogged down in the deep weeds of every single facility right now, but the key takeaway for your exam prep is that the LAF, SDF, and MSF are all your daily, short-term, transient tools. They manage the everyday bumps.
Right, but what happens when the central bank realizes they aren't just dealing with a daily bump?
Yeah, what if it's bigger than that?
What if there is a massive structural surplus or deficit of money in this system that isn't just going to magically vanish tomorrow? That is when they reach into the durable liquidity bucket.
The heavy listers.
Exactly. This bucket includes things like LTRO's long-term repo operations and LTRO's long-term reverse repo operations.
I mean, just by the name, you can tell the tenor of the operation is stretched out significantly, right? It's providing a more enduring impact than just an overnight fix.
Yes, the time frame is much longer. But the most classic, fundamental, durable tools are FOMOs, open market operations.
Okay, FOMOs. And here is a crucial distinction we need to make. We just talked about repos, where bonds are exchanged with a promise to reverse the trade. But under FOMOs, the operations are the outright purchase and sale of government securities.
Outright. That is the absolute magic word here.
Outright purchase. No takebacks.
None. If the central bank sees a permanent systemic shortage of liquidity, they don't just lend cash overnight. They go into the open market and buy government bonds outright. They take that bond onto their balance sheet permanently, and they inject that cash into the banking system permanently. The baseline salary of the economy has just been permanently increased. Exactly. And conversely, to durably absorb cash, they sell bonds outright.
Got it. Now, another massive durable tool mentioned is changing the CRR, the cash reserve ratio.
Now, this one is perhaps the bluntest instrument of all of them.
Oh, yeah. It's a sledgehammer.
It really is. The CRR is the percentage of a bank's total deposits that it is legally required to lock up in a vault with the central bank. If the central bank raises the CRR from, say, 4% to 5%, they instantly, durably suck a massive amount of liquidity out of the entire banking system all at once.
It changes the entire mathematical foundation of how much banks are even allowed to lend.
It's a huge move.
Okay, so we have OMOs, LTROs, CRR. But there is another tool in this durable bucket that I think requires a very deep look because it addresses a specific, really fascinating vulnerability. It's called the MSS, the Market Stabilization Scheme. And the framework notes that
Mm.
the MSS is deployed in situations when the use of OMOs becomes inadequate due to collateral constraints.
Collateral constraints. Let's really visualize what that phrase implies because it's a huge concept.
Yeah, I have to admit, when I try to picture a central bank running into a constraint, it feels counterintuitive. I mean, they control the money. Why would OMOs ever be inadequate? Why can't the central bank just keep selling government bonds into the open market to absorb an infinite amount of surplus liquidity?
To really understand that constraint, you have to imagine a scenario of extreme, relentless surplus.
Okay.
Let's say India experiences an unprecedented economic boom, right? And massive, massive waves of foreign investment are just flooding into the country. Billions and billions of dollars are converting into rupees, flooding the domestic banking system with a tidal wave of enduring surplus liquidity.
And if there is too much money sloshing around, the WACR crashes, inflation spikes, and the central bank basically loses control of the economy, so they have to absorb it.
Exactly, they have to mop it up. So they turn to their durable tool, OMO sales.
Ugh.
They start looking at their own balance sheet, taking the government securities they already own, and selling them to the banks. They say, give us your excess cash, here's a bond. Give us more cash, here is another bond.
But wait, the central bank's balance sheet is finite, isn't it?
That is the constraint.
Mm.
The central bank doesn't just have an infinite vault of government securities sitting around. They only have what they have previously acquired. If that tidal wave of foreign capital is big enough, the central bank will keep selling bonds until they literally reach the bottom of the barrel.
Wow.
They will actually run out of appropriate government securities to sell.
They hit a physical collateral constraint. They have no more paper to trade for the cash.
Exactly right. And when they hit that wall, they trigger the Market Stabilization Scheme, the MSS. It's this ingenious workaround.
How does it work?
Under the MSS, the government itself steps in and issues brand new special government securities, MSS bonds, solely for the purpose of absorbing that excess liquidity. The central bank sells these new MSS bonds to the market, pulling the cash out. But crucially, the cash absorbed through MSS doesn't go into the government's regular spending account.
Right, because if the government just spent it on, infrastructure or something, the cash would just flow right back into the economy, defeating the whole purpose of absorbing it in the first place.
Precisely. The money is locked away in a separate, sterilized account at the central bank. It's brilliant. The MSS bypasses the central bank's own balance sheet limits, which allows them to absorb massive structural shocks of liquidity without ever running out of collateral.
That is incredibly clever. Okay, so let's summarize the toolkit so far for the listener. You have your transient bucket for daily wallet fluctuations, LAF, repos, SDF, MSF. Then you have your durable bucket for structural salary changes, LTROs, FOMO outrights, CRR, and the MSS for when you hit those collateral constraints.
But, having a shed full of tools doesn't make you a mechanic.
No, it doesn't.
Knowing the tools is only half the battle. The real complexity of central banking is knowing when to use them and how much liquidity to inject or absorb on any given Tuesday morning.
Right, the diagnosis. And that brings us to the operational blueprint. To make these decisions, the central bank relies on the 2020 Liquidity Management Framework. This framework is essentially the diagnostic manual. And the foundational principle of this framework is that all operations are guided by two things: the prevailing stance of the MPC and a rigorous assessment of whether a liquidity deficit or surplus is transient or durable.
They have to diagnose the illness before prescribing the medicine. Is this a 24-hour bug or is this a chronic condition? And to make that diagnosis, the 2020 framework rests on two main pillars. Let's dive into pillar I first.
Okay, pillar one. The text defines this as near-term forecasts of autonomous drivers of liquidity. The phrase autonomous drivers is really critical here. Expert, what exactly makes a driver autonomous?
Autonomous means it operates completely independently of the central bank's immediate control. The central bank doesn't decree these movements. They are external variables.
They just happen.
Yeah. Human behavior, government schedules, global events. These things happen autonomously, and the central bank is forced to react to them, absorbing the impact to keep the WACR stable.
When you look at the framework, there are four major independent variables, four autonomous drivers that the central bank has to constantly anticipate. The first one listed is the demand for currency, which primarily reflects the behavior of households.
Let's create a scenario to visualize this because it's fascinating. Think about the weeks leading up to Diwali.
Oh, yeah. Huge spending.
Right. Across the entire country, millions of households decide they need physical cash. They want to buy gifts in local markets, they need to pay bonuses to household staff, or maybe they just hold cash for auspicious reasons. So millions of people walk to ATMs and withdraw physical currency.
And every single time an ATM spits out a 500 rupee note, that is a physical drain on the banking system's reserves.
It drains reserves entirely autonomously. The central bank didn't issue an order for people to withdraw cash. Cultural human behavior drove it. But the result is a sudden, massive deficit in transient liquidity.
And if the central bank doesn't anticipate this, if they don't inject cash to fill that hole, the banks will panic, scramble for overnight money, and the WACR will skyrocket.
Exactly. So the central bank has to expertly forecast household behavior. Now, the second autonomous driver is the demand for excess reserves. And this one reflects the behavior of the banking system itself.
Because banks are run by humans, and humans get nervous.
Exactly. Let's say there are rumblings of trouble in a specific corporate sector or just general economic uncertainty in the news. Normally, Bank A would lend its excess cash in the call money market to earn a little interest. But if they are nervous, they might decide it's safer to just hoard that cash as excess reserves.
They just pull back from the market entirely.
Yes. They voluntarily hold more reserves than they are legally required to, purely for safety. And that autonomous decision suddenly locks up liquidity. The cash is technically there, but it's not flowing.
It creates a sort of synthetic shortage.
Right, a synthetic shortage in the market which threatens to push the WACR up. The central bank has to sense that banking sentiment and adjust their injections accordingly.
Okay, driver number 3. This is the central government's balances with the Reserve Bank, and this depends entirely on the cash flows of the government.
This one is massive. Imagine advance tax payment day. Every major corporation in the country is transferring massive, massive sums of money from their private commercial bank accounts into the government's central account at the RBI.
In a matter of hours, trillions of rupees are just vacuumed out of the commercial banking system.
The system experiences an absolute drought of liquidity.
And conversely, think about the day the government disperses agricultural subsidies or pays salaries to millions of public sector employees. The government's account empties out, and money floods into private bank accounts across the country.
A sudden flood of liquidity. These government cash flows create violent, entirely autonomous swings in systemic liquidity.
So Pillar Ura is essentially a complex, high-stakes weather forecast. Will there be a drought tomorrow because it's tax day, or a flood next week because of government salaries? To generate these projections, the framework relies on a combination of forward-looking information, like knowing a specific tax deadline is on the calendar, and backward-looking time series evolution.
And backward-looking time series just means analyzing historical patterns.
Yeah.
They look at the data from the last 10 Diwalis to calculate exactly how much physical cash is likely to drain from the ATMs this year.
They use the past to forecast the near-term future.
Exactly. It's a very robust way to predict the weather. But there is a fourth autonomous driver in the framework, and this one comes with a massive flashing warning sign.
The wild card.
Yes. The fourth driver is Forex market intervention. But the framework specifically notes that this driver is dealt with without near-term forecasts. It is factored in as information becomes available.
Why does this driver defy the forecasting models? I mean, they forecast everything else.
Because the global foreign exchange market is the ultimate wild card. It does not follow a neat, predictable calendar. You know when tax day is, you know when festival season is. You have rich historical data for all of that. But you cannot mathematically forecast on a Monday what a geopolitical shock on a Tuesday will do to the rupee-dollar exchange rate.
You can't put a time series model on a sudden trade embargo or a war.
Exactly. If a global event causes the rupee to suddenly face extreme pressure, the central bank might have to intervene immediately, selling dollars and absorbing rupees. That autonomous action instantly drains domestic liquidity.
But because they couldn't forecast the geopolitical shock, they couldn't forecast the liquidity drain.
Right. They just have to react in real time as the information hits their desks.
This is such a vital distinction if you are trying to understand the limits of central banking for this exam. The domestic drivers, currency reserves, government balances, those can be modeled and forecast in the near term. The global driver Forex intervention is a wild card that must be managed on the fly.
Which perfectly transitions us from the daily weather to the overall climate. If Pillar Third is obsessing over the daily fluctuations of ATMs and tax deadlines, what is Pillar 2?
Pillar 2 is the long-term climate assessment. The framework defines Pillar 2I as an assessment of system-level liquidity over a relatively longer time horizon.
While Pillar First is looking at tomorrow or next week, Pillar Third is looking at the next quarter or the next year. It focuses on the structural, enduring growth in three key macroeconomic areas: broad money, bank credit, and deposits.
Notice the difference in scale there. Pillar I was worrying about temporary excess reserves. Pillar Thuris is asking, is the entire nation's appetite for bank credit growing or shrinking? Are national savings deposits expanding? This is the baseline salary of the economy, not the daily wallet.
And tying both of these pillars together is one of the most powerful yet intangible tools in modern central banking: transparency.
Yes, the 2020 framework places a massive emphasis on communication. It dictates that liquidity conditions and forecasts must be regularly published. You see this in the biannual monetary policy report, the MPC statements, and the annual reports. They are constantly telling the public what they see. But why? Why show your cards to the market? Why tell everyone what your weather and climate forecasts are?
Because transparency is not just an administrative chore. It is a deliberate psychological mechanism to manage market expectations.
How so?
Let's imagine the central bank foresees a massive temporary liquidity deficit coming up next week due to a rare alignment of tax outflows and festival cash demand.
A perfect storm of liquidity drain.
If the central bank stays silent, what happens? Next week arrives, the banks suddenly realize they're all short on cash, panic sets in, everyone scrambles to borrow in the call money market, and the WACR violently spikes. Chaos.
The nervous system shorts out entirely.
Exactly. But if the central bank is transparent, if they publish a statement saying, hey, we foresee a transient deficit next week, and we are already scheduling LAF repos to smooth it out, the psychology completely changes.
The banks see the storm coming, but they also see the central bank standing ready with an umbrella.
Exactly. There is no panic. The market stays calm. The WACR remains stable. By communicating transparently, the central bank actually prevents the volatility from occurring in the first place.
It's the financial equivalent of keep calm and carry on. The communication itself acts as a stabilizing tool. But even with all this forecasting and transparency, the framework acknowledges a profound truth. The models are not infallible. There is a specific mention that the central bank makes regular efforts to improve forecasting accuracy through something called improved market intelligence.
I find this fascinating because it highlights the limits of mathematics. You can have the most sophisticated, backward-looking time series data in the world. You can have supercomputers running algorithms on government cash flows. But a model only knows what has happened in the past.
It can't feel the subtle, real-time shifts in human sentiment.
It can't sense fear or optimism. Market intelligence means human intelligence. It means central bankers having their ears to the ground, talking to bank treasurers, understanding the mood on the trading floors, gathering qualitative on-the-ground intelligence to sense shifts before they ever show up in the hard data.
The plumbing of monetary policy requires human intuition just as much as mathematical modeling. Let's pause for a second because we have just mapped out the entire domestic landscape of market operations.
We covered a lot of ground.
We did. We understand the goal of transmission. We know that WACR is the pulse. We can distinguish between the transient tools like repos and the durable tools like FOMOs and the MSS. We've explored the 2020 framework, contrasting the near-term weather forecasts of Pillar First with the long-term climate assessment of Pillar Second, all band together by transparency.
It is a brilliantly designed, self-contained system, but there is a massive catch.
The catch is that India does not exist in a vacuum. It is deeply, inextricably integrated into the global economy.
And that reality forces us to look outwards. The second half of market operations isn't about domestic liquidity. It is about navigating the global ocean. We have to examine foreign exchange operations.
Let's establish the parameters here for the listener. The central bank has two main objectives when it comes to Forex operations. Objective 1, ensure the Forex market functions in an orderly fashion. Objective 2, help maintain an adequate level of foreign exchange reserves.
Notice the phrasing of that first objective, an orderly fashion. It doesn't say, fix the exchange rate at a specific number.
Right, they aren't trying to draw a line in the sand.
The central bank isn't trying to magically defy global economic gravity. If the US dollar is strengthening globally, the rupee will adjust. The goal isn't to stop the adjustment. The goal is to ensure the adjustment is smooth, orderly, and completely free of panic.
To achieve this, the central bank operates like a watchtower, closely monitoring developments in financial markets both at home and abroad. But they aren't just looking out the window for the sake of it. They are monitoring specific known vulnerabilities. There are structural realities that make India's forex market uniquely susceptible to sudden, violent volatility.
Understanding these vulnerabilities is paramount for the exam. Let's walk through the major ones. The first critical vulnerability is a significant reliance on capital flows. And these flows are described in the text with three very precise words: large, lumpy, and subject to sudden stops and reversals.
I really want to focus on the word lumpy. It's such a specific, almost awkward word to use in high-level finance. What does it actually mean for billions of dollars of capital to be lumpy?
It's an incredibly descriptive visual, honestly. When you think of money flowing into a country, we often imagine a gentle, continuous river. $10 million today, $12 million tomorrow. A smooth, manageable stream that the market can easily digest.
But lumpy implies something entirely different.
Lumpy means the capital does not flow. It drops. Imagine a massive multinational corporation decides to acquire a huge stake in an Indian telecommunications giant. It is a multi-billion-dollar foreign direct investment. That money doesn't trickle in over a year.
It all comes at once.
It hits the forex market as a massive, concentrated lump of US dollars, demanding to be converted into rupees, all on the exact same afternoon.
That is a massive shock to the system. Suddenly, there is a monstrous oversupply of dollars and a huge demand for rupees, which violently skews the exchange rate.
And the terror of lumpy capital is that it cuts both ways. The flows are subject to sudden stops and reversals. Imagine global sentiment suddenly sours. Maybe the U.S. Federal Reserve unexpectedly raises interest rates aggressively. Suddenly, all those foreign portfolio investors who brought their lumps of capital into India decide they want to move it back to the safe haven of U.S. bonds.
The river doesn't just stop, it completely reverses.
The massive lumps of capital rush for the exit simultaneously. They dump rupees and demand dollars, threatening to crash the value of the domestic currency in a matter of days. This is the first great vulnerability: the sheer unpredictable size and suddenness of global capital movements.
The second major vulnerability shifts from investment to consumption. It is the bulk demand for oil imports.
India imports the vast majority of the oil it consumes. This isn't a luxury. It is the absolute lifeblood of the domestic economy. And the global oil market operates in U.S. dollars. When major oil refining companies have to pay their international suppliers, they don't buy a few dollars here and there.
They need billions.
They enter the forex market with massive bulk demands to convert rupees into billions of dollars.
If several of these massive payments are due around the exact same time, it creates a concentrated spike in demand for the dollar, creating severe downward pressure on the rupee.
Which is very similar to the third vulnerability: the bunching up of government payments.
Right. Sometimes the government or massive public sector entities have large external debt obligations loans borrowed in foreign currencies that mature. If several of these massive repayments happen to bunch up and fall due in the exact same week, the government suddenly needs a mountain of foreign currency, creating another immense shock of demand in the forex market.
And tying all these vulnerabilities together is the ultimate unpredictable force: geopolitical events. Trade war fears, tensions in the Middle East, sudden embargoes.
When you look at these vulnerabilities together, you realize how interconnected they are. A sudden flare-up of tension in the Middle East is a geopolitical event. But what does that event actually do? It instantly spikes the global price of oil.
Exactly.
And that price spike means the bulk demand for oil imports suddenly requires dramatically more dollars than it did yesterday. And that sudden demand threatens the orderly fashion of the forex market.
It is a real-time domino effect. The global headlines immediately translate into pressure on the central bank's watchtower.
So we have the vulnerabilities. The central bank is standing on the deck of a ship trying to navigate massive, lumpy waves of capital, sudden bulk demands for oil dollars, bunched debt payments, and the unpredictable storms of geopolitics. How do they actually steer the ship? When the waves threaten to capsize the rupee, what is the weapon of choice?
They have various tools for intervention, but one of the most sophisticated and versatile tools at their disposal is the forex swap.
A forex swap. This is a mechanism that sounds incredibly complex, but if we break it down into its physical steps, its elegance becomes clear. Let's define the mechanics. What actually happens in a forex swap?
A swap is essentially two simultaneous interlocking transactions. It involves buying or selling foreign currency, usually the US dollar, against the domestic currency, the rupee. But the crucial defining feature is that at the exact same moment the initial trade is made, both parties agree to completely reverse the transaction at a specific, predetermined future date.
To really understand this, we need to walk through a concrete scenario. Let's look at the historical example from the text from 2020. The central bank used Forex swap auctions to provide US dollar liquidity to the market via a sell-buy swap. Let's put ourselves in the cockpit in 2020 and pull the levers of a sell-buy swap.
Okay, so in 2020, amidst global panic, there was a massive shortage of U.S. dollars in the domestic market. Banks and businesses desperately needed dollars to meet obligations, but the market just dried up. The central bank needed to intervene to provide USD liquidity.
So they initiate the first leg of the swap, the sell.
Exactly. The central bank reaches into its massive vault of foreign exchange reserves to take a large sum of U.S. dollars, and they sell them to the commercial banks. In exchange, the commercial banks give the central bank Indian rupees.
Let's pause right here and look at the immediate impact. By selling dollars, the central bank has successfully injected USD liquidity into the market. The banks have the dollars they desperately need to calm the panic. But simultaneously, because the banks had to pay for those dollars with rupees, the central bank has absorbed INR liquidity out of the domestic system.
That is the dual action nature of the tool. But it's a swap, not an outright permanent sale.
Right, so we move to the second leg.
Or the buy.
At the exact same moment the central bank sold those dollars, they signed an ironclad forward contract with the banks. The contract stipulates that in, let's say, 6 months, the central bank will buy those exact same dollars back from the banks, returning the rupees at a pre-agreed exchange rate.
It's a temporary exchange stretched out over a longer tenor. Now, because this is an interlocking, future-facing agreement, it creates two very specific accounting impacts on the central bank's balance sheet. First, it locks up foreign exchange reserves for the tenor of the swap. Let's visualize the vault again. The central bank sold the dollars today, so the physical dollars are gone. But they have legally promised to buy them back in 6 months. This means a portion of their total reserve calculation is essentially spoken for. It is locked up.
They can't assume those returning dollars will be available for some other permanent intervention.
Right, because they are tied to the completion of the swap.
And the second accounting impact. It reflects in the RBI's forward liabilities.
A liability is simply an obligation, something you owe. By agreeing today to reverse the transaction 6 months from now, to take back the dollars and give back the rupees, the central bank has created a future obligation. They owe the banks those rupees down the line. Therefore, the swap must be recorded transparently as a forward liability on the balance sheet.
When you lay out the mechanics like that, the sheer versatility of the tool becomes obvious. It isn't just a blunt instrument. It can be used to inject or absorb USD liquidity. It can be used to simultaneously inject or absorb INR liquidity. And it can be calibrated for a desired short-term or a long-term period by just changing the tenor of the swap.
It allows the central bank to intervene massively to calm global panic, without permanently depleting their reserves or permanently altering the domestic money supply. It is a masterpiece of financial plumbing.
And that plumbing connects everything. We have journeyed through the entirety of this complex, invisible landscape today. We started with the ultimate goal, the transmission of monetary policy from the brain of the MPC to the nervous system of the financial economy.
We saw that the real-world proof of that transmission is the WACR, the volume-weighted pulse of the uncollateralized overnight call money market.
We learned that to control the WACR, the central bank manages liquidity relying on a diverse toolkit, transient tools like LAF repos, SDF, and MSF to manage the daily short-term fluctuations of the wallet.
And durable tools like outright OMOs, LTROs, CRR, and the MSS to enact enduring structural changes to the economy's baseline salary, especially when faced with collateral constraints.
We explored the diagnostic brilliance of the 2020 Liquidity Management Framework, diagnosing the near-term weather through Pillar 3 by anticipating the autonomous behaviors of currency demand, bank reserves, government cash flows, and the wild card of Forex intervention.
And assessing the long-term climate through Pillar 2 by tracking broad money, credit, and deposits, while using transparency and human market intelligence to manage expectations and avoid panic.
Finally, we zoomed out to the global ocean, navigating the treacherous waters of foreign exchange operations, fighting the vulnerabilities of lumpy capital, bulk oil demand, and geopolitical shocks to maintain orderly markets.
All while wielding the versatile dual-action lever of the Forex swap to manage global liquidity without losing domestic control.
Before we wrap up this deep dive, there is one final, overarching connection that I want you, the listener, to mull over. We have treated domestic market operations and global foreign exchange operations as two different halves of the central bank's mandate. But if you look closely at the mechanics we just unpacked, you realize they are not separate at all.
Think about the sell-by forex swap we just walked through. The central bank executed that swap to solve a global problem to inject U.S. dollars and calm forex volatility. But what was the immediate mathematical side effect? They absorbed Indian rupees from the domestic commercial banks.
They suck domestic liquidity out of the system.
Exactly. And what happens when you drain domestic liquidity? Money becomes scarce. And when money becomes scarce, the overnight borrowing rate between banks goes up. Therefore, an action taken purely for foreign exchange operations instantly and physically impacts the domestic WACR we talked about at the very beginning of this journey.
The two halves are not separate. They are a single, continuously breathing, violently interconnected ecosystem. When you pull a lever to manage a geopolitical oil shock on the global side, you are simultaneously shifting the gears that determine the overnight interest rate on the domestic side.
That is the true challenge of the central banker.
Yeah.
You cannot touch one part of the machine without feeling the vibrations in every other part. The next time you read a headline about a massive foreign investment entering the country or global oil prices spiking due to tension abroad, you won't just see a news story. You will visualize the invisible plumbing. You will ask yourself, how is the central bank adjusting its domestic liquidity operations today to absorb that global shock without letting the WACR spiral out of control?
That is the difference between memorizing definitions and understanding the machine. You are no longer just looking at a list of acronyms. You can see the invisible gears turning. You can see the levers being pulled. You possess a deep structural understanding of how the nervous system of the economy actually functions. Best of luck on your exam. You have the knowledge you need. Now go crush it.